Hello, I'm Blake, and today I'm recommending Nathan's Famous for a strong buy with a price target of 118.8 and upside of almost 75%. Heading straight into my investment thesis. Though Nathan's may seem a small company in regards to market cap and revenue, it has a long history since 1916 and a very strong brand that has resulted because of that. And then looking over the last 35 years, secondly, we can see that there's not only a long history of value creation because of the strong management, which is still leading the company, but it's also because of the natural strength of the business model, which they have helped mold. And then going into the third reason, currently there's kind of a headwind with there's being a slump to beef prices and also general inflation and economic woes. And so pretty much as we return to normal, the hot dog industry should continue to grow, along with Nathan's continuing to take share as it has done historically. Going into the history, it began in 1916 as a normal hot dog stand, but by the 1970s, it had over 40 company-owned locations and over 10 franchises. But in 1987, it was acquired by EchoCore Group, with one of the members of current management, Howard Lorber, leading that acquisition, and he is still chairman currently. And so, but by the early 2000s, him and his associates had bought 3 brands, with one of them, Arthur Treacher, still being around. The other 2 were divested. And they have expanded into supermarkets, starting with a partnership with SMG and now with Jonathan Morale. They extended that partnership since 2014 and have had over 70,000 points of distribution. Going into the licensing segment from before, with those 70,000 points, they get a 10.8% royalty rate, and from that, they got $33.5 million in revenue and profit, with the John Morale license doing 90% of that, and other ones in other ancillary goods making up the rest. Because of the nature of it being a royalty, they're able to get inflation plus pricing related to growth. So that average around 3 to 3.5% over the years. And with the next segment of the branded product program, that is actually a food distribution segment where it's pretty concentrated in terms of revenue, with 78% from 5 customers, but that's mainly due to the types of business of those being large franchisors themselves, such as Auntie Annie's. And so pretty much, though cost pressure recently has hurt the ability to pass on prices, there is recovering volume, and assuming prices stabilize, there should be a good economic situation and there should be more growth in this segment. In regards to the restaurants, there's 4 company-operated locations in New York City and around 238 units throughout the rest of the world, along with 100 to 200 virtual kitchens. The goals of both of these 2 last segments have been mainly brand engagement, along with being kind of like a profitable marketing method, which I will go into more. Going into the industry, we can see the top 10 largest Frankfurter brands, and so Nathan's was around 4 to 5, but the thing about this industry that is different from, say, Tyson, is that it's much less commoditized, as brand and quality are large differentiating factors versus that of price, as prices are already pretty low in the low to mid-single digits. So this basically creates a situation where a brand like Nathan's, can price itself at a premium, and using effective and cost-efficient marketing, it can kind of shine and gain market share, as you can see in this graph, as it has done over the years. Going into kind of how they've done this cost-efficient marketing, it's really part of their omni-channel strategy. Having these 3 segments, which is more like 4 if you separate the franchise and the company-operated restaurants, the branded product distributing part of it, it's pretty low risk, little capital, and it's pretty much just operating as an intermediary between other distributors and Jonathan Morale. And so that's able to send to vendors across the nation and kind of get Nathan's brand out significantly. There's also the company restaurants, which have a lot of nostalgia surrounding them, and the July 4th contest that has over 2 million viewers each year on ESPN. Additionally, the franchise system with 238 units also gets the name out, similar to the BPP. Overall, this kind of creates a flywheel effect, where it becomes a very capital light, efficient, and overall strong model that kind of feeds into itself in terms of marketing itself. Going into the management and the shareholder alignment, we talked about Howard Lorber, who is now the current chairman and former CEO. So he led the PE acquisition, and he has influenced the company's business model shaping a lot. And so though he has a pretty exorbitant salary of 1.6 million, one could argue, he still does own 23.8% of the company, and so I believe he is still very aligned with shareholder goals. Heading into the new CEO, well, relatively new, about a decade old, Eric Gadoff, he led the supermarket expansion with Jonathan Morale, so he's definitely accomplished. He's a former IP attorney, so kind of aligns with the vision of valuing a brand. And so he owns around $5 million of stock, and relative to his $600,000 salary, I believe it's fair. And so overall, not only the CEO and chairman, but the entire board is well aligned, owning almost 18% of stock, along with there being two other major funds involved, kind of to show that there's some parts of the market that recognize the value here. Going to capital allocation, so Lorber has really shaped it with his private equity background. So he's done 2 senior note issuances in the last decade that pretty much used to solely fund special dividends, along with having a regular dividend of roughly a 3% yield currently. So the important part about these debt-funded dividends is that they pretty much, when retained earnings are negative, they create a situation where there's a non-dividend capital distribution, which is a return of capital as classified by the IRS, which means that cost basis is reduced and it's pretty much all tax-deferred compounding, which is pretty much directly comparable to a stock repurchase without having to worry about the market recognizing it. So very nice. Going into the discounted cash flow analysis, we could kind of see all of here like the growth over time. It's around a steady low single digits, with a lot of the depending on like the BPP growth rate, though it's higher than the others at 3%. It is at the lower end of its range of 3 to 4%. The license growth rate is around long-term inflation plus 0.5, which is lower than historical. And then the restaurant growth rate reflects stagnant volumes and the system not really growing, but they should be able to maintain their pricing power. Additionally, the 8% discount rate I used was from a capital asset pricing model with 0.6 as beta and around a 4% for a 10-year treasury rate used for the risk-free rate. We can see the target price here of Iran with around 75% upside. Going from the discounted cash flow analysis into the peer analysis, for specifically the licensing and franchising side of the business, we get a comparable set of quick service restaurants, and we could kind of use EV to EBITDA and cash flow yield to see that. The multiples of 15, 12, and 12 are kind of fair for the licensing and franchising segments respectively. And then going into the BPP segment, food distributors offer a pretty apt comparison. So that gets an upside of 68% using a peer multiple valuation, which is only around 6 to 7% off of the discounted cash flow valuation, kind of confirming my thesis. And that regardless of valuation method and kind of perspective on valuation, the idea is still there and the thesis is there. Going into ESG, we have 5 physical locations, so not much footprint. There's a pristine social plate with 70% minorities employed and no labor incidents in all of history. Along with that, we already discussed that not only is the board independent, but it's heavily aligned with 18% share total and over 40% if you include the chairman. Looking into AI, the opportunities are really just limited to labor productivity in terms of software. If we instead look at kind of like within the entire market, we can see that a lot of the hype from AI has been drawn to technology. So that has definitely led to capital outflow in the food industry. So that may leave natural opportunity in the sector as a lot of people aren't staying with their capital. So it's definitely an interesting field right now where kind of going in the opposite of capital flow direction may be the smart idea. And that's why one supporting thing for investing in Nathan's Famous. Going to the catalyst, I believe that because there's sophisticated credit investors investing in the bonds, that kind of helps to recognize the value difference between the two. Along with that, there's the possibility of senior notes being issued, again, to fund the special dividend, or an acquisition, which I view much less likely, but still possible, by private equity or a quick service restaurant. Additionally, there's the risk of higher meat prices, overall seasonality causing working capital requirements, the royalty rate decreasing, though I don't view that likely given the relationship, along with interest rate risk relating to a note issuance and private label and competitive risk. Really, in conclusion, I modeled many of these. A lot of these situations were not included with my model in terms of the upside, so I believe that there's still significant upside of 60 to 70% from the current share price given their omni-channel capabilities, consumer staples brand, efficient marketing, and low-risk royalty nature of the business. Thank you for letting me speak today.